Every single day, millions of people log onto trading platforms with a simple assumption: the market can only go up or it can go down. Even if you have absolutely no strategy, random guessing should theoretically yield a 50% win rate. With a coin flip chance of being right, you might assume that staying afloat is easy, and making a profit simply requires a bit of discipline. Yet academic studies reveal a harsh reality. Over 90% of retail day traders lose money over the long term, with some studies tracking the failure rate as high as 97%. This isn't because the market is rigged, and it isn't because retail traders lack intelligence. It is because they are playing a game where the underlying mathematics are heavily stacked against them from the very first second. To understand why, we have to look at three mathematical concepts: expected value, the gambler's ruin, and the asymmetry of human psychology. Let's start with a fair coin toss. If you bet $1 on heads and you win $1 for being right, your expected value, or EV, is 0. Over 1,000 flips, you will likely end up exactly where you started, but day trading is never a fair coin toss. Every time you buy or sell an asset, you pay a hidden tax. This comes in the form of broker commissions, exchange fees, and something called the bid-ask spread, the difference between the price you buy at and the price you can immediately sell at. There's also slippage, which occurs when the price moves slightly between the moment you click buy and the moment your order is filled. These tiny costs are known as market friction. If your trade entry and exit costs represent just 0.1% of your position size, your coin flip is no longer fair. Instead of winning $1 or losing $1, you now win 99 cents on a correct prediction and lose $1.01 on an incorrect one. Mathematically, your expected value drops from 0 to negative. When you scale this up to hundreds of rapid-fire trades, the law of large numbers takes over. The random wins and losses cancel each other out, leaving only the steady, compounding drain of transaction costs. Over time, a negative expected value guarantees account depletion, regardless of your conviction. Even if a trader manages to find a strategy with a genuinely positive expected value, say a 60% win rate, they can still face complete ruin. This is explained by a classical probability theorem called the gambler's ruin. Imagine two players flipping a coin. Player A has $10, player B has $1,000. Even if the game is completely fair, player A has a massive disadvantage. Because player A's capital is finite and relatively small compared to player B's, a brief run of bad luck will reduce player A's capital to 0, eliminating them from the game entirely. Player B with vastly more capital can easily survive a streak of consecutive losses. In the stock market, you are player A, and the market is player B, an opponent with essentially infinite capital. Most day traders overleverage their accounts, risking 5, 10, or even 20% of their total capital on a single position. Even with a highly profitable strategy, probability theory dictates that consecutive losses are inevitable over a long enough series of events. If you risk 10% per trade, a normal statistical fluctuation of 10 consecutive losses will reduce your balance to 0. Once your capital is gone, you can no longer place the next trade, preventing the law of averages from working in your favor. Professional risk management isn't a recommendation. It is a mathematical boundary condition for survival. The final math trap lies in how our brains process gains and losses. In a rational world, a trader who wins 50% of the time could still be profitable if their average win is larger than their average loss. If your average win is $200 and your average loss is $100, you have a solid mathematical edge. But human psychology naturally acts in reverse. Behavioral economics shows that humans feel the pain of a loss twice as intensely as the joy of an equivalent gain. When a trade goes into the green, anxiety takes over. Out of fear that the market will reverse and take away the paper profit, traders often close the trade early, locking in a tiny $50 win. However, when a trade goes into the red, the opposite happens. Instead of cutting the loss at $100, traders hold on hoping the price will recover so they don't have to face the psychological pain of accepting a loss. They turn a short-term trade into a long-term hold, letting a small loss compound into a massive account-ending disaster. By taking small wins and letting losses run, traders systematically distort their mathematical edge, turning a potentially profitable system into a negative expected value trap. Day trading fails for most because it forces human intuition to compete against cold, hard probability. To win a game with negative expected value and high friction, you cannot rely on charts, gut feelings, or hype. The only way to survive is to change the parameters of the game. Minimize your transaction costs, enforce strict risk limits to survive statistical variance, and mathematically decouple your exit targets from your emotions. If you want to build wealth, stop trying to predict the next random tick of the clock. Instead, Focus on building systems where the mathematical edge is structural, transparent, and always in your favor.